Hello everyone, and welcome to another edition of ChartYourTrade.com's free webinar series. I am your host, Michael Lamont. I am the founder of ChartYourTrade.com, and today we'll be discussing Trading Psychology 101, Human and Markets. With us again is keynote speaker Adam Sarhan. Adam is the founder and CEO of Sarhan Capital, which is parent to FindLeadingStocks.com. Without further ado, here's Adam.
Psychology 101, Human and Markets. There's one of my passions behind the markets is psychology. I love to know, pardon the pun, what makes you tick. We all have different motives, ambitions, likes, dislikes, ... So the way, from an emotional standpoint, I've looked at markets, studied them every single, we went through some of the consolidations in the bull markets, the bear markets. I went back even further, all the way to the 3rd century, and looked at a bunch of stuff and economic cycles and booms and busts. And I've noticed that the markets change, the bubbles the people change, the years change, the demographics change, the culture changes, the religions change, all that are all variables. But I asked myself, what is the one constant? What is the one thing that just never changes? And it's psychology. Psychology, in my opinion, is the one constant in markets. If you go back 100 years, you had bubbles. You had 29, the Roaring Twenties, and the Depression, and you go back to the 1600s and the tulips, and the list goes on and on and on and on. But the one constant is fear and greed. That whole dynamic really comes into play, and that's really, really important. So what I asked myself, I'm like, all right, if psychology is constant, how do I navigate, the market? How do I actually make sense out of it? And this was some of the seeds that were planted to help me create that damp investment system, and really help me formulate my own opinions with respect to interpreting what I see happening in the market. And here's a great quote that I like from a famous investor. He goes, great investors conceptualize problems differently than others. These investors do not succeed by accessing better information. They succeed by using it differently than others. So the information's all out there. Lots of people used to come to me and say, "Oh, Adam, how do you, private information or inside information, that type of stuff." You don't need any of that stuff to succeed in the market. You just need to understand yourself, understand the market, and realize that whatever you're feeling, the market doesn't know you, doesn't care about you, you're feeling it. It's a neutral event. The market goes down, the S&P is down 23 points today. It's a neutral event. If you're long and you bought exactly at the high of the day today, clearly you're not happy. But the market doesn't know if you're happy or not happy. It's a neutral event. It's your decision on what type of emotions or how you interpret what's actually happening. The other analogy, which is really powerful too, is traffic. No one that I know of that likes sitting in traffic. However, traffic itself was a neutral event. Your choice to be pissed off and angry and screaming and flipping the bird and doing this, that, and the other thing, it's your personal choice whether or not you're happy or not happy in traffic. The other guy right next to you, in front of you, and behind you could be sitting there listening to the radio, listening to some books on tape, whatever it is, and just loving life, even though that you're both sitting in the same exact part of the highway, and you're sitting in traffic, the same exact area, but it's your decision. You can control your attitude, and it doesn't change the external environment. What I want to focus on here is adopting a healthy framework, mental framework, because that's what you can control. You can't control the market. You can control your attitude. Hope that makes sense. So there's 3 factors that primarily move markets. There's fundamentals, which we all know. It's intrinsic and subjective. It's a value of what's the proper valuation. Twitter came public today. Everyone's going nuts over Twitter. Okay, great. What's the value of Twitter? What's a stock worth? The company loses money. So as far as I'm concerned, I know lots of other guys I like to give my money to that actually are profitable and have revenue. But and there's hundreds of companies, not thousands of companies that are out there that lose money that are publicly traded. But the fundamental data, there's earnings and growth and ... But how many times have you seen companies that have stellar fundamentals and the stock gets killed? I'm sure the answer is numerous if you've been around for a while. As far as the technical data, same thing. I've seen breakouts fail time and time and time and time and time again. I've seen stocks and other markets too, not just stocks. And everything I'm saying applies to nearly every publicly traded market there is. Technically, this market looks great, and then all of a sudden, in a blip of a snap your finger, blink your eye, boom, it just breaks down, or it goes the other way. It looks awful, then it goes right back up. I mean, even the S&P just a month ago looked awful, and people were telling me it's going to crash. It's below the 50. It's this, that, and the other thing, and it was a 4.5% correction, or not even correction. Sorry, it was a 4.5% pullback, and then it just took off and went straight up. So again, there has to be something else. It led me to I asked myself these questions for years before I was able to really put the pieces together, and the missing element was psychology, as far as I'm concerned. Emotions, in my opinion, drive markets higher and lower, and that trumps everything else. Yeah, sure, fundamentals are important. Sure, technicals are important. But I've seen so many stocks that have no fundamentals, awful, outright awful fundamentals, double and triple in price. Biotechs that lose a boatload of money go up tenfold. The list goes on and on. Technicals, I can show you stocks that have awful charts, and the market goes straight up. I show you a dozen charts right now that look great, and they go straight down. So really, the question is price. How do you determine price? So from my standpoint, I look at price as George Soros, a legendary investor, had said it best. It's all perception. If you're able to gauge perception, what are you willing to pay? Why is a Picasso worth so much? Because that perception, that value is there. So if that perception, Tesla, for example, the stock went up 400% this year, from $40 in Q1 to almost 200 in just a matter of months, because the perception was that this is a game changer and it's going to change the way people live their lives and buy cars and da 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 da. So that really is a very, very important element. The next logical question, which many of you may have, is how do you determine perception, or how do you quantify it? And that's more of a subjective input. You've got to synthesize a lot of data. There is no just 1 + 1 = 2 from a psychological or emotional standpoint. Unfortunately, it's a different animal. So if you look back at markets and ask yourself how do they work, John Templeton, one of the greatest investors out there, had a great saying, and this is from Kimball's charting service, a blog that's frequently trafficked by a lot of these guys. And the first one Templeton said was pessimism. Bull markets are born in pessimism, out of like the most worst times. Another great example on Wall Street is you buy when there's blood on the streets, right? So what does that mean? Not literally when there's blood on the streets, because thankfully we live in societies where you don't need to get blood on the streets, but buying when fear is just dominating. It's just fear or greed, if you simplify it even further. So when others are buy when others are fearful and sell when others are greedy. That's the old adage as well. And all these cliches and market adages come into play. I just want to help you make sense of it all so you can actually understand it and then use it for your own analysis. The bull markets, every single one in history, and we just went through all of them over the past 100 years, are born from extreme pessimism. They grow on skepticism. Nobody believes it. Everyone's saying, oh, this is BS, it's an oversold rally, it's an oversold bounce, blah, blah, blah. Then all of a sudden they mature on optimism, somewhat where the phase where we are now. And it could be made a case that we're entering that euphoria phase or have entered it. But they die when people are just going gangbusters, when they're euphoric. When you go in, the famous line was 1929, Joe Kennedy, JFK's father, had said it best. He made a fortune in the market, shorting the market. Why? He went to go get his shoes shined one day, and the shoe guy who was shining his shoes had asked him, hey, Joe, give me a stock, or what do you think about this stock? He was bullish on stocks. So Kennedy was like, okay, this is too much. Not to say there's anything wrong with the shoe shiner. It's just the euphoria had transcended so far that, in modern day parlance, the taxi driver is bullish on stocks. That there could be somewhat of a bubble forming, or you're towards the end of, at least in the latter phase of that bull market. So that's from the psychological standpoint. Keep those in mind for your own psychology and also the market psychology, because we divide them into two sections. There's your psychology and then the market psychology. So the first section is your psychology. Why do most people lose money in the market? Again, I can't even tell you how many times I've banged my head against the wall asking myself this question. Forget about the making the money, right? Why do people just lose? And they keep coming back for more and more and more and more and more. And they keep coming and they keep losing. And I see these guys, destructive behavior, and it's their doing. No one's forcing them. No one forces you to buy or sell anything. We'll get into that in a second. But I asked myself this question, and really it came down to it's that most people make emotional decisions in the market, not rational. And if you don't believe me, I can give you so many examples. You yourself look at your trades over the last 12 months, and myself as well, and you see there are many, many, many times where you just make emotional decisions, not rational. Even if you follow a system, you follow rules, lots of the decision to buy or sell, you might second guess it. And that's a lot of it's due to the fear and greed component, that emotional side that comes into play. In life, not just in markets, I'm a strong believer of this. Most rational and intelligent people make irrational decisions every single day. and it's not just irrational, but it's emotional decisions. The greatest example is just look at what happened in D.C. at the shutdown. You have the U.S. government shut down. Seriously, I mean, it's Seth and Amy from SNL used to have a skit. Really, that definitely is the front and center for that really skit. Daylight savings time. Can anyone explain to me why in today's day and age we have to turn the clocks back and almost have a mini jet lag for all of us around the world? It makes no sense. People still do it, but it makes no sense. More on a more granular level, look at anyone that's on a diet. How many times have you seen a situation where people are on a diet? They know there's two things to do to lose weight: you eat healthy and you exercise. It's not, in theory, it's not difficult, but emotionally it feels very good to eat that piece of cake or cookie or whatever it is, and it's difficult to go to the gym and work out and eat healthy. So people tend to eat healthy, and they're making an emotional decision, not a rational decision. Even though they say they want to make money in the market, we'll get there in a second, their actions counteract that. From a solution standpoint, what is a solution? I like to ask myself, is this smart? Whatever it is in life, it doesn't have to be just the markets. What am I doing right now? Is it smart? If the answer is not yes, I catch myself all the time. I just don't do it. And I'm not saying that I'm a super genius. It's the furthest thing from that. It's just a matter of, okay, I know that I'm going to behave irrationally. I'm going to make emotional decisions. So I know that I have a want, for example, to use that food analogy. If I want to lose weight, then I know eating that ho-ho or Twinkie or shoving that cookie down my face isn't smart. So it doesn't align myself with my top want, which is in this case to make money in the market. So I need to ask myself, what are my decisions and my actions? Is it smart? Is it aligning me with my goal of making money in the market? If the answer is not yes, I just simply don't do it. And I try. If anything to take away from this webinar, just try this one sentence out next to any decision you make, large or small. Few other things to discuss about the market, which most people don't talk about. There are no rules in the market. You're free to buy and sell anything you want at any time. There's no gun to your head. You don't have to be fully invested. You don't have to be bearish. You don't have to be bullish. Just because you bought something at 2 o'clock doesn't mean you can't turn around and sell it at 2:01 or even sooner. Or it doesn't mean you have to sell it. Or it doesn't mean you can't buy more of it. So one of the great lines, one of my mentors had told me years ago, he goes, the market can't take any money away from you that you don't let it. And, okay, well, what if the market gaps down on you? That's a different story. You can buy puts to protect yourself or whatever the case is, but for the most part, just normal trading in and out, you let the market, and I've read it somewhere as well. It's a known belief out there. I don't want to take claim to that thought, but it's definitely something that helped me out a lot, where I realized, okay, I don't have to do this. I need to do what works. And again, going back to your wants, if you're able to say my top one is to make money, therefore navigate the market successfully. If what I'm doing doesn't make me money, even though I follow the XYZ system and it's by this legendary guy and XYZ, whatever the case is, that's fine and dandy. It could work great for him or her. It just doesn't necessarily work great for me. So I need to find out what works for me and then do more of what works and less of what not. That's what Dennis Garman says. Markets are counterintuitive in nature. Just realize that as you move forward. When you saw the slide of the market pulling back 4.5% just recently, everyone's freaking out. The market's going to crash. The market's going to crash. The market's going to crash. They're counterintuitive. All of a sudden, the S&P shoots up over 120 points or 110 points. So be very careful, even more in a very short amount of time. So be very careful. Just understand that as you navigate, markets are counterintuitive in nature. And then again, you're free to buy and sell anything at any time. The problem that most people have, this is your psychology section, is that these are foreign concepts for most people. They just don't understand that. We're told since childhood that you must be told what to do. You have to follow the rules. In school, if you don't follow the rules, you're punished. You don't do your homework, you're punished. Every major religion tells you the same thing. You got to do this, otherwise you're going to hell. There's all these rules embedded ever since we're conditioned that way since we're children. And to really be effective in the market, you've got to reshape your thinking and break free somewhat of that traditional mindset of, oh, I have to do this, I have to do that. Really, you don't, and it makes a lot of people uncomfortable. They love to have that rule. I know people that, fall in love with the system, devoted 10 years of life to this investment system. It makes them no money. They lose money every single year, but they won't drop it because, oh, I've committed. I've given so much time to this cause, or not just a system, anything in general. I'm committed. Again, it's irrational behavior, but people still do it. And just, again, it's counterintuitive. People love rules. They love to be told what to do. And if you look at the masses, and that's true for the masses. So if you're able to just drop that for a second, reframe your thought process to realize you don't have any set rules, you can do what you want as long as it's legal. In my book, I have two rules: ethical and legal. Then I'm free to do it. So if it's not ethical, it's not legal, I'm not going to do it in the market. Otherwise, it's you pretty much you can do it whatever works. And what works for you might not work for me. The best example of that, if any of you read Market Wizards, there's a few volumes, a few books of those. It's one of the best books out there. But there's some of these guys, and these are guys with phenomenal returns, do the exact opposite of what other guys do. So one guy might do A or black, the other guy does white, and both are successful at it. So it's the beauty of this market where it's such a vast amount of opportunity. What works for one guy might not work for the other gal, and vice versa. So it's very important for you to come up with rules that work for you. Excess freedom causes most people to become overwhelmed. They just don't know what to do. So I'm just going to follow this guy's rules. It works for him. He's successful, so why not work for me? And that's, again, they're intellectually, not again, but most people at that stage, they're intellectually lazy. They don't want to do the work themselves. It's very, very difficult. It's not a 9 to 5. It's hours upon hours upon hours, years and years, if not decades, to really get it and figure out what works. And again, what works for you based on your own preset of your psyche, based on what your likes are, what makes you tick. Most people are dominated by fear in life and in markets. And I call this fear-based trading. And that's another reason why most people lose money, because not only do they not know what to do, but fear dominates them. And or that emotion, the greed on the other side, the euphoria, but really it's that fear. I don't want to buy this because I'm going to lose money. So they don't buy it. Stock goes up. Oh, I should have bought it. They kick myself in where because I didn't buy it. And then all of a sudden, the next time around, they do it. Meanwhile, they shouldn't have done it, and then they lose money. They're stopped out. So what are they doing there? It's more that fear-based trading begets more fear, and it leads to sloppy trading and bad results. A lot of people have rules, but they just don't follow them. They break their own rules. Again, we mentioned earlier, human nature never changes, and that's really, really important because all of us are human. That I'm hoping that are on the presentation tonight. And even if you have rules and systems, I mean, systems are more or less discretion, and you plug them into a program, and the program tells you what to buy or sell, more or less. And I have the utmost respect for systems, and I think they're great. And if any of us can develop them, by all the more power to you, because why not backtest 30 or 40 or 50 or 60 years worth of data than just going it alone? But human nature never changes. Just understand that as you go through that environment. Markets are fluid. There's no beginning, there's no middle, and there's no end. There's just the now. So if you interact lovingly with the present moment, it's more of a spiritual guide, but I take that and apply it to the market. Well, a great book came out years ago, The Power of Now, and that basically says, okay, the only thing that matters is right now, the present moment, right? So same thing with the markets. I don't know what's going to happen tomorrow. I'd lie to you if I did, and no one knows what's going to happen tomorrow. If they did, they'd own a few islands in the Caribbean, if not half the world. But I do know what's happening right now, so I can interpret what's happening right now, and I stay flexible. When the facts change, I change. And understanding the stronger intermediate and longer term trends, and then try to align myself with those trends. So again, how you think is everything. In the markets and in life, emotions win. In the real world, markets often move based on raw emotions, which we mentioned before. It's not just fundamental or technical data, and that was really eye-opening for me. Look at movie stars. Can you possibly tell me that the best actors in the world are the highest paid? No. Why? Because it's emotion. Oh, I love this guy's performance. Okay, when enough people love that guy's performance or that gal's performance, all of a sudden, that person becomes an A-list actor. Same thing with cars. Look at the Ferrari example is the best one. Super expensive car, there's no lousy mileage, extremely expensive to repair, and change a basic, I think it was, what was the thing, a switch or something like that, a knob was multi-$1,000, but yet people go out and buy them, and it's beautiful, it sounds great. Again, the emotion wins. Same in capital markets. I think that point now is pretty much clear. And everyone has different reasons for buying and selling your stock and or whatever market you're buying. Just because you like something for whatever reasons, whoever you're buying it for, you press buy, someone's selling it to you. So what's their reason? Why'd they sell it? And then just realize, again, look at things from that emotional standpoint or the psychological standpoint. You really, really help your emotional state and also your own bottom line. Great book Dr. Alexander Elder had written, Trading for a Living. A few good quotes come out of there. He makes the analogy that the market's like an ocean. It moves up and down regardless of what you want. You may feel joy when you buy a stock and it explodes and rallies, and who doesn't? I mean, you're making money. You may feel drenched with fear when the market goes against you. But more or less, these feelings have nothing to do with the market. They exist only inside of you. And that's really, really powerful for you to understand. The market doesn't know you exist. Again, nothing you can do can influence it, unless if somebody in the line here is, a central banker. But besides that, more or less, it's a drop in the ocean, and it's like a wave. If you stand there and try to block a wave, it's still going to crash. There's nothing you can do about it. It might even knock you over. So try to ride the wave instead of blocking it. And then most professional traders remove their emotions. Successful traders, really, I would change it to say, remove their emotions and stay calm. And if you get stopped out, you get stopped out. It happens to the best of us. You move on, you move forward. It's inevitable. If you're in this business long enough, you're going to get stopped out. So the next question becomes, how do you handle those losses? Which we'll get to in a second. So really, how you think is everything, because that's what you can control. You can't control the market. You can't control the stock. You can't control the external events. The Fed QE tapers, doesn't taper, whatever. It's just noise. Their earnings, this, that, and the other. It's all noise. What you can control are your thoughts, your feelings, how you think. And if you can adapt and maintain a positive, healthy environment, you're going to do much better, because strength begets strength in markets and also in life. It's not just a market thing. And be very careful to when you mix your emotions with your trading. Getting aggravated or bummed out or angry, or those negative emotions don't do you any good at all. And when you feel that you're off or you're on tilt, just back off. Take some time off. You don't need to be invested in the market every day. You need to be trading every day or every week or even every month or even every year. You have the luxury of taking off until you have a clear head. And that's really, really important for most people to understand, that the market's not going anywhere. The question is, are you going to be around to be involved or not? And if you're off your game, back off. That was very helpful as well. Again, be humble, and then just really want to follow a proven system that gives you those technical conditions. The market's telling you that you're right or wrong, and it confirms your thesis. And that's what you want to look for, and stay on board as long as you're aligned with the overall market. The key is to align yourself with what's actually happening, not what you think is going to happen. And that's really, really important. So again, one of the ways to control what you control is, what is your top want, right? So we all have different wants, and that's what you can control in life and in markets. Do you want to make money from the market? Do you want the drama, the story, the excitement? Do you want a roller coaster? You want to be able to tell somebody at a party, hey, look what happened to this stock. I can't believe this story. Do you want all that drama, or do you want to just make money? Most people want the drama, the story, or the excitement, and they say they want to make money, just like the weight loss. I want to lose weight, but I'm shoving, Cheesecake Factory, 500 calorie, 1,000 calorie cookies and dinners down my face every day, and it's okay. Well, do you really want to make money? That's really the question. So there's your psychology. Other part of it is the market psychology. Try to avoid groupthink. Most people are wrong. The question is your barber bullish or is your taxi driver bullish? That type of thing, which we discussed earlier. And ask yourself, are you late to the party? We all know about late stage bases. For the most part, markets move in stages, in different bases within an uptrend. And when are you getting in? Are you getting in early, or are you getting in late? Are you buying the dip? Are you buying the rip? Are you somewhere in the middle? Human psychology. In order to be successful in life, you must take a long and hard look at what makes you tick. That's one of my favorite quotes. Ed Sequoia, this guy's, again, market wizard and genius in this business. He goes, win or lose, everybody gets what they want out of the market. Some people seem to like to lose, so they win by losing. And that, to me, was super powerful, because some people like the drama, and some people want to win, they get that. Some people want to lose, they get that. Most people say they want to win. Okay, well, what do you have to do to win? Well, I don't really want to do all that stuff. In other words, equate to the working out. I don't want to do the sit-ups. I don't want to go run, a few miles every day or every other day, whatever it is. I don't want to do the hard work to win. Okay, so what do you really want? What's your top want? And what do you want most? In life, this has been very helpful to me as well. Step one, decide what you want, irrespective, whatever your goal is. Build a plan to accomplish it. How do you want, how are you going to get that goal? How are you going to do that? And then take action. And then when the facts change, you change. Other thing that's helpful too is, are you hot or cold? We talked about that briefly, the tilt. There's Dennis Gartman's quote of do more of what's working, less of what's not. We all go through spells of being hot and not. Sometimes we're hot, sometimes we're cold. It happens everything. It ebbs and flows. If you walk into your local, retail store, Starbucks or Dunkin' Donuts or the store in the mall, you just stand there for a few hours. You're going to see there's times where the mall is just packed or the store is packed, and there's times where it's just dead. And the same thing in life, in markets. Sometimes you're hot, sometimes the phone's just ringing off the hook, and sometimes no matter what happens, it's crickets. So, I like that trading tilt. That's a gambling term. If you're on tilt, if you're cold, back off. It'll pass. There's no question. Just wait. You have to be cognizant of it and then let it pass. Know what state you're on. Again, if you're hot, do more. If it's not, then back off. Trade with conviction instead of fear. I'm not saying to be a cowboy because that's not a good way of trading. Most cowboys fail and burn and die. Their portfolios die. But as far as I'm concerned, if you can create that optimistic, positive mindset, not disregarding the facts. If you're down, 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 I'm not saying to be hunky-dory, everything's great. No, clearly there's a problem. Interpret what's actually happening, but really understand that what's driving you. Is it fear? If you're making fear-based decisions, you're going to lose, more or less in the long term. I've noticed that, everyone I talk to. If you're doing it with conviction, hey, listen, I trust my system, it works, more importantly, I've seen results, it works for me, you're going to do better. And there's the 80-20 rule, which we know. I use this in life. 80%. It's a little bit opposite. The 80-20 rule typically is 80% of what you do doesn't make any. Doesn't really. It's not accretive to the bottom line. 20% of your clients are your best clients and help you make you the most money. Same thing here, but it's a little bit opposite. 80% of the trading being successful is mental, if not 90%. I could even make a case it's 95%. The 20%, what you actually, the mechanics. There's lots of different ways of doing it, but really if you have the mental mindset, that's huge, and that's so important. A few cognitive biases. I know that we're running low on time, so if we do go over, bear with us. If this will also be available on demand if any of you have to go, but I'll breeze through this. So a few cognitive biases. What's a cognitive bias? A bias in general. Well, it's a person's tendency to make errors in judgment based on cognitive factors. So there's a lot of them here. I'm going to just touch on a few of them. But more or less, again, we make emotional decisions. So what are they? And there's a lot more. If you just Google cognitive biases, you'll see hundreds of these. In Wikipedia, they're all over the place. But these are a few that have to do with the market. So anchoring. Basically, you buy a stock at 10, it goes down to 8. Facebook was a good example where you had the IPO, it went down 60%, and then it goes back up. Overhead resistance, they call it, or overhead supply. People anchor their price. Oh, I bought it at 10, I need to get out at 10. You don't really need to get out at 10, but other people feel that way, right? So that in and of itself feeds on itself. So that's an anchoring bias. Do you do it? That's something people have to say, because anchoring causes you to say, all right, I'm going to hold on to this. Even though I'm underwater, I'm losing money, and how much lower can it possibly go? Because this is my price. Or it was trading at this price yesterday or 2 weeks ago. Well, where are we today? Where are we right now? That's the whole point of shifting your focus from anchoring in the past to focus on the now, where we are right now. Confirmation bias. It's very, very careful. This is easy to get mixed up in, because you look for data and you just use it to confirm your thesis. In other words, if you're bullish on stocks and the market's going down, you just say, oh yeah, stocks are getting cheaper. Well, that's not, it's confirming your thesis to a point. If the market goes back up, okay, great, that confirms your thesis. So lots of people get confused here and misuse data just to confirm what they're saying. Oh yeah, the market's getting cheaper. Don't worry about it. It's fine now. It's fine now. It's fine now. All of '08, I can't tell you how many people told me the market's getting cheaper, and they're no longer in business. Same thing in 2000. Same thing in any other bear market. So be very careful of this bias. Sunk costs, irrational escalation. This is a great example. When you're down, you average down, you buy some more when it goes down. You're so far underwater. Who cares? How much? It's already gone. Like you wrote it off in your mind. It's one of my best clients and friends back even the last decade or 15 years or so. I've seen people that are very, very intelligent people, and they trade full time at big shops. I mean, multi-billion-dollar portfolio shops, and their portfolio managers at these places, multiple places, and they write stocks to zero in their own personal accounts. Oh, I don't care if it goes to zero. I'm in. I'm committed. That type of thing. So be very careful of the sunk cost effect. I don't care if it's only that much, or you wrote it off as a loss. Well, you don't actually lose money until either the stock goes to zero or you sell. But the second that you're underwater, you're losing. You're not making money. So that needs to be, even though you don't sell it, you got to be very careful. Let's go to the next slide. Illusion of control. This is one of my favorite biases of all time. Not just in markets, but in life. We all have an illusion that we're in control. Some people believe that they can control everything in their life. I'm a big fan of saying, okay, no. What you can control, your wants. You can control your attitude. And besides that, not much of anything you can control. Sure, you control your actions, but besides that, what if something happens to you? There's so many external events that happen all the time, health, weather, whatever it is, the market, whatever it is. What you do truly can control are what you want, your attitude towards whatever that is. The event's neutral. It's your choice whether it's to be positive or negative on it. Information bias is another important one. It's basically seeking information that affects your thesis. Whether, in other words, why is the market moving in a specific direction? I need to watch TV 24 hours a day and just watch the market, just get someone to give me information, just to control my bias. The status quo bias is just people are comfortable in I like to call it, they get comfortable in the uncomfortable. So in other words, your situation is not ideal, but I'm comfortable doing what I'm doing, so I'm not really going to push myself out of my comfort zone. And that happens all the time. And then another powerful one is the outcome bias. People tend to judge their decisions by the outcome rather than the logic used at the time. So in other words, if I buy a stock today and it goes down tomorrow, I'm stopped out for a loss, it was the wrong thing. I lost money on it and . Not necessarily. Actually, in some cases, you can argue the exact opposite, because if you made the decision right at the time with the information that was in front of you, the outcome's irrespective. It doesn't matter. So what really matters is the process, the input. The output is secondary, because if you do the right process time and time again, you will be successful. But it's important not to judge your decisions based on the outcome solely. Obviously, they're important. If if the outcome's wrong every single time, then clearly what you're doing doesn't make any sense. But if your outcome has a positive expectancy, meaning it's right over a long enough period of time, that's what matters. The recency bias and risk aversion. Risk aversion, people, in theory, want to avoid pain, and that's it's devastating. You see people, I'm not going to sell a stock because I don't want to take that pain of being lost, having that loss realized or recognizing that loss. The loss gets much bigger, 9 out of 10 times. The recency bias, when asked to recall a list of events in order, just a free recall, if I just the last 20 slides, most of us really, the more recent slides you can remember much, much better than you can the first 2 slides. And the same thing's true in the market. Oops. So that's more or less an overview of some of the biases that we exhibit. The groupthink or crowd psychology, another one, the bandwagon effect. You just go with the crowd. Everyone's jumping off a bridge. I'm going to jump off also. Obviously, I'm exaggerating to illustrate the point, but the reality is that this happens a lot with stocks. Oh, everybody's buying the Twitter IPO. I've got to buy it. Or the Facebook IPO. It's just one of the situations where you've got to think in the market in order to be successful. You've got to be able to think for yourself and take responsibility for your decisions. Every decision you make and every decision you don't make, so everything you do and don't do has a consequence. So if you decide to buy, there's a consequence. If you decide not to buy, there's a consequence as well. So not to suggest that the consequence is good or bad. It's just there is a consequence to every action, and deciding not to buy or not to sell is also a decision that has consequences. So keep that in mind, and it's really important, and especially in the market, to be able to formulate your own opinion, even if everybody is against you. Listen to the market, because the market is always right. These are just a few of the biases that all of us encounter every day in all aspects of our lives. The more you go over these, the more you familiarize yourself with them, the easier it is for you to overcome them.
Thank you all for watching, and we hope that you enjoyed this video. If you're watching it on YouTube, please take a moment and click the like button down here at the bottom, and also take a moment to subscribe to us here on YouTube. If you'd like to try out Adam Sarhan's Buy Leading Stock service, where he talks more about market psychology, the current state of the market, leading stocks, and provides a model portfolio with exact entry and exit points, visit buyleadingstocks.com and enter discount code CYT and get 10% off of any membership level. Again, visit buyleadingstocks.com and use discount code CYT when you check out. Thank you and have a great day.